Hello everybody, welcome to my talk. I am here again informing you on the last little part of stocks. So it's information on stocks. Where can you find information and become knowledgeable on stocks and how they calculate. So I'm just gonna read right off the bat. The most of the calculations you need to access and track the value of a company's common stock are provided in summary tables of trading activity on the three major stock exchange sorry, I thought it ended, but here we go. Stock exchange that appear daily in the Wall Street Journal, the New York Times, and Barron's, and practically every hometown newspaper in the country. So you can find information on stocks on all the newspapers. And where you go to find this information is on there's three major places, which is the New York Stock Exchange, and the abbreviation is the NYSE. Even I knew the New York Stock Exchange because you hear about it all the time. But this one lists 800 companies. This one lists 2,000 of the biggest boasting high level of capitalization companies. So, you know, the usual big ones that I name: Disneyland, Coke, Pepsi, General Motors. All those big companies are in the New York Stock Exchange, and it's called Big Board because they are the companies that move, you know, the country, have a lot of power. And then they have the Amex, AMEX, which is the American Stock Exchange. This lists 800 companies, most small to medium, and tend to be less profitable. But they have some big ones also, which are, they have most of the American oil and gas companies on this American Stock Exchange. And then they have the NASDAQ, which is the National Association of Securities Dealers Automated Quotations. That's what that all means, NASDAQ, which I also hear a lot in the news. This one lists 400 mostly small cap and foreign companies over-the-counter stock. So I'm going to turn it around and show you what it lists, but it's weird to me, but I will show you and kind of read to you. Shoot. Let me put this here. There we go. But it's how to read the exchange tables, and it's pretty cool. Let me show you here. So this is what you would see in the newspaper. So this high-low here is, you know, in a year, 52 weeks. So in a year, it's gone from a high of 93, and the lowest it's sold is 57. And this 57 is $57.50, $93.50. This is a make-believe one, so they called it, this would be the stock name, ABC Corporation. And the symbol is how they sell it. So when you go to your, you know, account that you open to buy stocks, if you wanted to buy stocks from ABC Corporation, you would request it as ABC. For example, the stock that I bought from Beachbody, it's called Body, B-O-D-Y. That's how. And then the dividends, I'm not sure how to explain that over here. It's the stock is currently paying an annual dividend of 90 cents per share. So that would be this. and then the yield is 1.0, which per share, and yields 1% in real terms, which I don't understand what that means. And then it has a price earning ratio of 22. That would be this. And then brokers usually buy stocks in round of lots of 100 shares, but can purchase them in odds. The figure 7966 was the trading volume that day in hundreds of shares. So I guess this is how many shares they traded on this day. And in this particular day, the highest that the share was paid was $93.50, and the lowest was 91. And when it closed at 93, so that was a exchange rate of 2. It's a +2 because the lowest was 91, so it went up 2 points, and that's where it closed. So that's a good thing. And that, my friends, is how you read this, these tables on the newspaper. So it's going to have like Disney, and then whatever the symbol is for that, and all the information. Like on today, the day that you see it is going to be here, and this is the average in the last 12 months. So pretty cool, right? So I kind of get that. I don't get, you know, the yield and the dividends, but I think I understand that little table. So if I were to go to the newspaper, I would understand what I'm reading. And then it goes on to talk about the market index. That I didn't get. So I just wrote the names of the market indexes. And this is where you, okay, for example, the DJIA, which is the Dow Jones Industrial Average, they base their average, like the average of the best stock that they have, or that's available. Let me see, because I think they only do so they have 30. So I guess when I was reading, they started with 10 companies, and they decided how the stock was going based on those 10 companies. And that's when they started back in 1884. That was the first major index place that calculated, you know, what you should do with stocks. Should you buy or not buy, based on those 10 big companies that they decided this on. So after a while, they added 20 more. So now, and it has been for a long time, it's 30 companies that make up, you know, their decision making on if the stock is going up or down. And they have a little formula here. It's the sum of all 30 shares, meaning the 30 companies that they chose, divided by 30 components, and then divided by 0.345, which let's say it's 0.34, less than 1. For the sake of example, let's say it's the distortion of the value of the things. But anyway, that's what they have. That's what they do. They grab a bunch of stock and decide from there what is going to be better or not, but if it's good to buy or not buy stock, depending on those big companies. So then from there, then they made other index companies like Standards and Poor's. They use 500 companies to decide how the stock is going. Then they have the NASDAQ Composite Index, and then they have the Value Line Composite Index, the Wilshire Quality 500, and then you know, they also have the New York Stock Exchange Composite Index. And so it's these index places that kind of grab a couple of the bigger companies and decide at that point for us, you know, oh, it's not looking good, or what is it, a bear market, or there's another one. Okay, so it's either good or bad, but this is what dictates how it's going. And then I'm just going to read this from the book as the last thing. Why invest in stock? And the final analysis, it comes down to this. The thing we have forgotten is this country is that every investment option is either attractive or unattractive depending on its price. You can pay too much for stocks, but when you bought at a reasonable and preferably cheap price, and when bought by those who have the financial staying power to withstand the inherent volatility of the stock market, stock, particularly the Dow 30 blue chip, have proven that without a doubt to be the most profitable of the liquid investment options over time. So it's riskier, but if you're looking to spend more money and you're young enough to replace it if you lose it, the stock is the way to go. And now we're going next Thursday, part 2 of the book, which is risk and reward don't always go together. So stay tuned for that. And for now, this is what I have. We're done with stocks. It's all exciting to me, and I hope is that it's exciting for you too. And in stocks, you could go ahead and start doing it now, as opposed to bonds, where I'm still saving up to try and invest in that. But for now, I'll see you next Thursday with new information. Hope you like it. Subscribe. I love you guys. I hope you love me the same. Bye-bye.